Writing code for a hedge fund isn't glamorous, it's war. Every bug is a landmine, every trade is live ammo, and today, I'm taking you inside the battlefield. When people ask me what it's like to write code for a hedge fund, I always start the same way. It looks glamorous on the outside, blackboards of math, fast markets, trading desks, but day to day it's engineering under pressure. You're not just inventing clever indicators. You're building reliable systems that must survive noisy markets, human scrutiny, and real money. Much of the job is software engineering, not just statistics. Version control, reproducible backtests, deployment pipelines, monitoring, and, perhaps most importantly, disciplined risk controls that keep a fund from doing something stupid with your code. That practical orientation shapes the whole lifecycle of a strategy. It begins with an idea, a market anomaly, an intuition, a thesis lifted from a paper, or a hunch based on experience. The immediate job of the developer researcher is to translate that thesis into a testable hypothesis and a reproducible experiment. The best practitioners treat this like scientific method. Define the hypothesis, state the time period and instruments you'll test, and fix transaction cost assumptions and portfolio constraints before you touch the data. If you skip that discipline, you're just data mining for noise. There are formal protocols and papers that lay this out step by step. Institutional shops follow repeatable development pipelines so that strategy selection doesn't become an emotional or ad hoc process. Now, let's talk tools. If you want to be useful to a hedge fund, learn Python deeply. Python dominates the research to production path. Pandas for time series munging, NumPy for numeric kernels, scikit-learn and LightGBM for modeling, and then production frameworks for order execution and monitoring. Many funds use C++ or Rust for microsecond critical components, but the vast majority of signal research, risk calculations, and orchestration lives in Python. You'll use Jupyter or a similar environment to prototype, then package code into modules that can be versioned and tested. If you're working in FX or retail channels, MetaTrader remains ubiquitous for retail EAs and quick prototyping, but it's rarely the core of an institutional quant stack except for bridges to brokers. Many pros prefer Python plus institutional execution gateways. If you want easy strategy discovery without code, tools like Strategy QuantX exist. They can generate ideas and automate tests, but they are not a shortcut around proper statistical rigor and production readiness. On the subject of backtesting, take it extremely seriously. A backtest is a hypothesis test that must guard against overfitting and data leakage. There is a rich literature on how backtest overfitting destroys out-of-sample performance. The practical discipline is to separate train, validation and truly out-of-sample test sets, use walk-forward or nested validation, and quantify the probability that a good backtest happened by luck. Many hedge funds adopt formal backtesting protocols for machine learning and systematic strategies to reduce cheating with hindsight. If you take only one lesson away from this video, let it be: treat backtesting like a research protocol, not like a scoreboard. So what does a robust development process look like in practice? Here's a workflow that maps to real fund practices and that you can use in your own projects. First, idea right pointing arrow data. Get high quality, clean historical prices and fills. Minor timestamp misalignments, non-adjusted corporate actions, or bad tick data will wreck your conclusions. Second, exploratory analysis. Visualize the signal, check for structural regime changes, and inspect economic plausibility. Third, initial backtest with conservative assumptions on transaction costs, slippage, and capacity. Fourth, robustness checks. Perturb parameters, test on different assets and time windows, add noise, run a walk forward. Fifth, stress tests in adversarial scenarios. What if volatility doubles, liquidity dries up? Sixth, paper trade or run in a shadow account to check real execution. Seventh, if all is well, push to production with feature flags, circuit breakers, and live monitoring. Every step requires tests and reproducibility, unit tests for code, regression tests for P&L, and reproducible notebooks or artifacts that auditors can rerun. The Braverock-Peterson approach and similar firm playbooks describe this pipeline in institutional detail. Let's get concrete around practical tools and pitfalls. For prototyping, Python plus Pandas is your friend. Use vectorized operations, but profile aggressively. A naive Python loop that processes tick data can kill performance. Use Cython, Numba, or re-implement hotspots in C++ when latency matters. For more no-code exploration, Strategy QuantX and similar products can speed the idea generation stage. They automate cross-market scans and robustness tests. But their outputs must be critically evaluated and stress-tested. Many users find their exported strategies underperform in live trading unless heavily audited and re-engineered. For FX retail or algorithmic EAs, MetaTrader, MT4, MT5, remains useful for quick experiments and for Debian-style demo accounts. But it's not the canonical institutional deployment environment. You'll still need a robust execution gateway, order manager, and risk layer. Software engineering discipline is non-negotiable. Hedge funds expect reproducibility, maintainability, and traceability. That means Git, code reviews, continuous integration, C, pipelines, reproducible Dockerized environments, structured logging, and standardized metrics. It also means operational code that runs 24/7 with health checks, sane retries, backoff strategies, and clear circuit breakers if risk limits are breached. The real world punishes brittle systems. Naive scripts that assume perfect connectivity will blow up when a market hiccup or vendor outage happens. Forums like Quant Stack Exchange and practitioner posts are full of cautionary tales about infinite loops, race conditions, and data format mismatches that only show their teeth in production. Quantitative finance stack exchange risk controls and observability are where good devs add disproportionate value. You must instrument everything. For strategy latency histograms, per instrument slippage estimates, realized versus expected fill rates, and live risk exposures. Build dashboards that show P&L attribution, exposures, and what changed diffs after any code push. Good monitoring is not just alerts. It's structured dashboards coupled with automated mitigation. For example, automatic pause of a strategy if daily drawdown exceeds the preset limit, or rolling back a problematic code release. Hedge funds often have separate risk engines that independently compute exposures and will kill executions if anything looks off. If you can build reliable monitoring hooks and meaningful alarms, you will be invaluable. And yes, you'll spend half your career fixing dashboards. Now, let's be honest about the controversies. First, overfitting and fake alphas are rampant. Tools that discover thousands of strategies, including library generators, almost guarantee some strategies that look great in sample but fall apart live. A whole subculture of strategy generators follows the same trap. Huge search spaces plus insufficient penalization for multiple testing leads to spurious winners. The only cure is disciplined out-of-sample testing, multiple robustness checks, and economics that justify the signal. Second, there is the AI question. Large language models and automation are changing workflows. Some firms embed LLMs into research and operations to speed writing, documentation or hypothesis generation. But AI replacing the core quantitative insight is still debated. Firms are automating many analyst tasks, but alpha discovery remains hard. Big funds are experimenting with AI tools but remain cautious about over-reliance and model interpretability. Recent press shows rapid adoption of AI for efficiency gains, not wholesale replacement of quants. For people building careers, hedge funds hire developers with a mix of skills, solid programming, numerical background, and good engineering practices. You don't necessarily need a PhD to be useful. Many successful quants migrated from other finance roles and learned Python and statistics on the job. What's differentiating is the ability to reason quantitatively about markets, communicate clearly with traders and researchers, and ship reliable production code. In interviews you'll be tested both on algorithms, data structures and on system design questions. How to build a resilient execution system, how to instrument risk, so prepare for both. Practical tips you can use right away. First, use high-quality data and version it. Second, automate unit tests and regression tests for P&L. Not just numeric tests but integration tests that mock market data and execution. Third, log relentlessly and include deterministic identifiers in logs so you can trace a trade from signal generation to actual fill. Fourth, simulate execution. Apply realistic market impact models and randomize fill assumptions during robustness checks. Fifth, when you promote code to live, do so behind feature toggles so you can disable it fast. Sixth, always compute capacity and scaling. Your model might be profitable on tiny size but utterly impractical at institutional scale. Finally, document everything, reproducible reports, methodology notes, and a short, model risk brief that tells the risk team what scenarios will break the approach. If you want to approach this using the tools I mentioned, start in Python to prototype your signal and backtest with conservative assumptions. Pandas plus vectorized backtester or a framework like Zipline, Backtrader if you prefer. Use Strategy QuantX or similar as a brainstorming engine if you want automated idea generation, but treat its output as raw material, not finished product. For paper trading and execution glue, you can use broker APIs, interactive brokers, fixed gateways, and run a demonized execution engine that separates signal from order management. When latency matters, profile and isolate the hot paths in a compiled language and keep the orchestration in Python. Above all, aim for modular design. Separate data ingestion, signal generation, risk checks, and execution in distinct services with well-defined interfaces. Let me finish with a realistic view. Writing code for a hedge fund is intellectually rewarding and intensely practical. You will see your code handle real money. You'll be forced to think about edge cases, and you'll learn that success is as much about reliable engineering and risk management as it is about clever math. The industry is evolving. AI is augmenting workflows, and new data sources and compute architectures open possibilities. But the foundational practices remain the same: rigorous testing, reproducibility, conservative production assumptions, and constant skepticism about your results. If you adopt those habits, you'll not only survive in a hedge fund environment, you'll thrive. Thank you for following, and if you liked my post, please like and subscribe.